Let me hit you with a question that sounds simple, but it trips up a lot of smart people. If you have $2 million saved for retirement, why can retirement still feel unstable? Because in retirement, assets don't pay bills, income does. And today we're going to discuss what I call the retirement paycheck problem. I'm Dustin Rudolph, owner and president at Legacy Ascent Wealth, and welcome to this episode of Summit Ascent Retirement. By the end of the episode, you're going to know the difference between I've got a big portfolio and I've got a paycheck that I can actually live on. Most people spend 30 to 40 years in a paycheck system. Money shows up every 2 weeks, bills go out, life feels predictable. Then retirement happens, and a lot of plans are basically, here's a portfolio, good luck. Retirees don't usually fail because they didn't invest. They struggle because nobody turned the portfolio into a reliable paycheck. And that creates anxiety, even with the high net worth. And here's the mistake. When you're working, you ask, how much do I make? When you're retired, we're trained to think, how much do I have? But the question that really matters is how much can I reliably spend every month without wrecking the plan? Because withdrawals aren't neutral. In a recent article published by Kiplinger last month called What Science Reveals About Money and a Happy Retirement, people with paychecks were much happier than those relying on portfolio withdrawals because of the certainty it brings. Because if the market drops early in retirement and you're pulling income, you can permanently damage the plan. That's called sequence of returns risk, and it's one of the hidden risks retirees face. So let's make it real. Two couples both have $2 million. Couple A has Social Security that's covering most of the basics, a pension or some type of guaranteed income, and their investments are extra, flexible, used for that discretionary spending. Couple B has Social Security, but it does not cover the basics. No pension. The portfolio is responsible for everything, and they're withdrawing no matter what the market does. Same assets, totally different retirement experience. Because the feeling of safety comes from the reliable monthly income, not the size of the account. That's why the Society of Actuaries has long emphasized that more predictable income equals more protection for retirees. So what counts as reliable income? We break it up into two different buckets. Income that you can't outlive, Social Security, pensions, annuities if they're appropriate. This is the keep the lights on layer. And then income that can change, which is portfolio based. Some examples of that are withdrawals from IRAs or brokerage accounts, dividends, interest, which is nice but not guaranteed, and flexible spending. This is your lifestyle and legacy layer. The foundation plus upside concept shows up in retirement income research and planning frameworks. Cover essential expenses with secure income, then invest for growth for flexibility on top. Here's where retirees get stuck. They hear, just use a total return approach. Stocks go up over time. And yes, over long periods, market tends to reward investors, but retirement isn't just about average returns. It's about the order of returns and the timing of withdrawals. People get caught up too often in what the average return is, when the timing often means so much more. So instead of relying on one big portfolio and hoping it behaves, we build an income layering plan. Income layering means intentionally stacking sources of cash flow so that essentials are covered, volatility doesn't force bad, irreversible decisions, and you keep flexibility for that travel, gifting, fun, and legacy. And here's solid research showing that incorporating some form of guaranteed lifetime income, and let's face it, nothing is guaranteed, not your Social Security, not your pension, not the annuity income payment. It's all based off of the claims paying ability of who's issuing it. Just want to make sure that we have that clear. So guaranteed lifetime income can improve retirement outcomes for certain households, especially when it reduces downside risk and stabilizes spending ability. And what this allows us to actually do, with two risk tolerances equal, if you increase that base layer of spending, if you want to keep the risk level in the portfolio the same, you can actually increase your risk in the other investments without jeopardizing how you're getting that retirement income. This is not an annuities for everyone approach. It's use the right tool for the right job based on goals, taxes, and risk tolerance. Now let me show you exactly what I mean with a simple example. A 70-year-old couple with a $2 million portfolio. And what you're looking at is our income planning software, Income Laboratory. And Income Laboratory utilizes the Guyton guardrail approach, which is a system that says you can take about 5.2 to 5.8% of your portfolio. And if the assets grow and you hit the upper guardrail, in this case it's 2.5 million, your income increases. If the assets decline, then we're going to have to take a payment cut. And so what this does is it optimizes the amount of income. And also, we're never worried about running out of money because we're adjusting it. And that flexibility allows us to get more income up front. And so in this scenario, with a $2 million portfolio, they're getting about $140,000 per year. But look what happens when we take $750,000 from the $2 million portfolio to purchase a deferred income annuity where we're getting lifetime income at RMD age of 73. The income actually increases and it stabilizes that base as well. And if you look, we have their $3,000 worth of Social Security and then about $5,700 worth of annuity payment. And in the black here, you can see this is the portfolio that they're taking withdrawals from in order to sustain their income. If we're relying just on the portfolio, then almost all of their income is relying on how the market does and the portfolio being able to sustain itself. And here's the real benefit. So what happens if you retire right before a down market? And in this case, our software allows us to see how our plan would sustain itself if we were to retire right before the global financial crisis in November of 2007. And the blue line here is utilizing that additional lifetime income, and the yellow line is being completely dependent on the portfolio. As you can see, we start off with just slightly higher income with the higher predictable income, and then once the global financial crisis hits, the difference is $950 higher having that lifetime income integrated into the portfolio, because as you can see, just utilizing the portfolio, the balance goes below the lower guardrail, and then it stays that way until 2020. And in May of 2021, the portfolio only approach now gets an increase for a slight period of time before they level off again. So in these scenarios, you're getting 12 years longer of $1,000 per month in that lifetime predictable income. What we didn't cover within the income software is the behavioral reality, because risk in retirement, it's not theoretical, it's personal, it's emotional. It's that moment when you get that nagging feeling that I should sell now that the market has crashed, and then you don't get back in until it's highs. It's making permanent decisions in temporary storms. If you retired tomorrow, could you easily answer these questions? What pays your essential bills every month no matter what the markets do? Which accounts fund your fund money, and how flexible is it? What happens to withdrawals if the markets drop 20% in 1 year? And do you know your tax impact and withdrawal order? Taxes are a paycheck killer if ignored. If those answers are fuzzy, you don't have a paycheck plan yet. You have investments. So here's the bottom line. A retirement plan isn't just a number. It's a system that turns savings into paychecks you can live on through good markets and bads. If you're in or near retirement and you want a second set of eyes on your income strategy, you can reach out through info@legacyascent.com or visit us on our website. In our next episode, we're going to talk about the other side of this, how to build an income plan that stays tax efficient so your paycheck doesn't leak out through avoidable taxes. This is Summit Ascent Retirement. We'll see you next time.